You are listening to chartingwealth.com's comprehensive review and forecast for the week beginning Monday, the 22nd of January, 2018. You see on the screen one of our popular trainings, Mastering the Market, with our weekly market worksheet. For everyone who's a subscriber to the channel, there's going to be a link in the email that you receive with your comprehensive review and forecast. Those of you who are on the email list, check it. There will be a link there that will take you to this training video. I very much encourage you to please watch it over the weekend. Print out the sheets, the weekly market worksheets. And when you listen to this video that we're just about to go into, the market review, fill out the weekly market worksheet. If you only have time to fill out one of the worksheets during the course of the week, at least do the weekly, particularly if you are a long-term trader or long-term investor, really. If that's what you're interested in learning how to do, make sure you fill out that weekly market worksheet. Very, very important. If you are not already subscribed to us, receiving our daily market reviews and our once-a-week comprehensive review and forecast, you can easily do that by going to chartingwealth.com and signing up. All the material is there. And at the end of this program today, I'm going to give you what I consider the master stroke for you to understand to be successful in trading and investing, but particularly in trading. And it's a trick we talk about all the time, and I can't overstate it. I'll share it with you at the end, but we always try to get through this material in 10 minutes for you. I'm usually late in doing that, but I'll save the little tips for the end. Let's jump into things. How did the S&P 500 end up over the week? Up, in fact, on Friday, up 0.45%, and it was an up week, a nice up candle, about the same size as the prior week's candle for the week ending the 19th of January. Remember, weekly candles always end on Friday at the end of the week. If for some reason the market's closed Friday, of course it would end on Thursday. This was a shortened week that didn't open until Tuesday. We see the derivative oscillator gaining energy, price percent oscillator moving up on the weekly chart. And of course, the chart's been moving up since the weekly vertical crossover back on the 29th of September, at least for us jumping into trades somewhere around 250. And of course, the market closed at some point during the day. It hit 280. That's about $30 since October. That's pretty amazing. October, November, December, and now about halfway through January. $30 per share up on a $250 ETF. That's pretty good, isn't it, my friends? And again, that's the magic of the weekly market crossover. Weekly vertical crossover, forgive me. Okay, let's look at the two-day chart, see what it's doing. Of course, we had a two-day vertical crossover back on the 4th of January, and it has been constant up movement since then. Just a beautiful chart, easy for a monkey to walk up. When you look at the stair steps on those two-day candlesticks, derivative oscillators losing some energy. Price percent oscillator, our most important, is moving up. Hope you guys have been enjoying Chapter 7 that we released earlier in the week. Not available to the public yet, only available to the folks that are members. Hope the members liked it. We would appreciate very much your comments. And it'll come out in a month or so for everybody else. But again, if you want the material that we have when we release it, please make sure to sign up. Okay, at chartingwealth.com, what do we see going on the 4-hour chart? Very interesting. The MACD is now almost laminated over the red signal line. We are negative on the price, well, I'm sorry, did I call it the MACD? The price percent oscillator is almost laminated on the signal line. The derivative oscillator has, of course, flipped over all the way back on the 17th and is negative. It's losing some of that downward momentum. Why is that? Well, we've had a sideways slide. We had the market peak out with a high of 280.09, and of course, when it hit a high, it hit up to 240, so it's finally pushed above that, but it's been sliding sideways. And of course, what happened to that oscillator? Well, it lost its energy with a sideways slide, particularly with the down afternoon on the 16th of January. So it's flipped over. The price percent oscillator is also getting weak. That's because of the sideways slide. Remember, for oscillators to work, you have to have oscillation. You have to have movement. And when you stop having movement, when things start peaking out and sliding sideways, they get sloppy. So keep your eye on things, particularly this 4-hour chart. At some point, the market will top off. Now, it may digest things for a while and pop up and go through some crazy stroking up. It may. But we'll keep our eye on things. We've done well with $30 of appreciation since the beginning of October, the end of September. So that's quite nice. We'll continue to watch things. Now, back to the weekly chart. What do we see on the Qs? The Nasdaq 100, the tech stocks up 0.31%. Remember, we had a weekly vertical crossover for the week ending the 5th of January, a couple of weeks ago. Things have been moving up quite nicely. It looks pretty beautiful, and as we continue to watch things go, we see the derivative oscillator gaining energy, the price percent oscillator moving up, and things are looking nice. The market closed just above the Bollinger Band. And of course, if we go to the 2-day chart, we see stair steps again moving up, again slowing down a little bit over the course of the last couple of weeks, but still moving up, price percent oscillator moving up, derivative oscillator moving up. Things are looking nicely, and again, it's just the first day of the latest 2-day candle. Price movement is above the weekly and the 2-day trend line. Of course, that's nice. And as we delve a little bit deeper in things, we look at the 4-hour chart, and again, we can see things. We had sort of, again, in the afternoon on the 16th, a little bit down, and the market took a while to recover and move above the price, the topper at 166.42. Let's see where things, 166.41. So things have just now reached the high point that they reached all the way back on the 16th. That's what's causing the oscillator to slide sideways, and that's the price percent oscillator, and derivative oscillator to go over negative. So we'll just continue to keep an eye on things and watch. Is the market long in the tooth? Absolutely. But we will keep riding that baby as long as she goes up, as long as our indicators tell us to do so, and price movement is going in that direction. We will get leery and wonder and concerned and cautious as things top out, and if indeed our indicators start showing us weakness, particularly weakness on the bigger charts. Okay, from the Qs to TLT, remember we had that Friday before last, the 5th of January, we had 3 different weekly vertical crossovers. The first was in the Qs, second was in TLT, which we're going into now. That was going down, Qs was going up, and the third was gold, which was going up. We see the week ending in exactly those same movements, not a change in the weekly vertical crossover. It's still pegged on the 5th of January. Hasn't changed. Things are still accelerating in downward momentum. We're now into our third complete week, well, second complete week after the weekly vertical crossover occurred. We can see going back 5 weeks of down movement, and derivative oscillator again, downward momentum, price percent oscillators moving down, red, solid box down candle. We look at the 2-day chart. We can see continued down movement. First day of the latest 2-day candle down strong. We had 2 days tracking sideways and up a little bit. I'm sorry, two 2-day candles, which represents 4 days. 2-day candling on the 12th and the other one on the 16th. Then we had a spinning top on the 18th, and so far the first day of the latest 2-day candle down. The last couple of days, 3 down. We see down 0.53% for the day on Friday. So again, things tracking in the direction of our weekly vertical crossover. Those weekly vertical crossovers are so telling, my friends. They really show us when the momentum has switched on that bigger chart, which is the key. Okay, what's going on the 4-hour chart? We see that the 4-hour chart crossed over going down in the morning. Of course, your jumping in place was in the afternoon. We told you to watch for that. If you had gotten out, were waiting for the 4-hour chart to cross back over going down, well, it has, and it did. Your jumping in time was to look at where things were after that candle closed around noon. And again, That's what we're looking for, is a pullback and then a movement in the same direction as the weekly and the 2-day, which was down, and that is occurring and happening. And of course, we're excited to see things moving exactly as the weekly vertical crossover told us it would. Is it always correct? No. No, we can't force anything. But is it a talisman? Is it a telltale sign of things that might be happening? Yes, it is. It is a telltale sign, not a talisman, a telltale sign of things that might be happening in the future, and it typically works all the time? Of course not. We can't control the market, but we can use the indicators, the signs, the experimentation, and things that we've tried and that work to help us, and I don't want to use the word predict, to help us trend follow established trends, because they do tend to move for longer than the time it takes us to spot them. Now, let's put it that way. That's a good way to say it. Okay, what do we see going on gold? Well, gold had a weekly vertical crossover again back on the 5th. And what have we had happen since then? 2 weeks of up movement. Day ended nicely for gold, up 0.44%. Remember, as we see, all things being equal, markets tend to move in the direction of the largest chart, which is for us the weekly. We do once a quarter look at the quarterly chart, but that's not what we base our investing and shorter term trading investing decisions on when we're doing our virtual trades. Now, let's take a look at what's actually happening. Gold, we see price percent oscillator not moving up at the same angle that it had been, stronger angle in the prior week, but moving up nonetheless. Derivative oscillator also moving up. As we look at the 2-day chart, what do we see? Well, it's flattened out pretty substantially. We had a spinning top on the 2-day candle ending on the 8th, tending down, 18th rather, and then on the 19th, first day of the latest 2-day candle, we have a green open box. Again, the movement's not up to where it was on the prior 2-day candle all the way back on Tuesday the 16th. So again, weakness sliding sideways in gold. Again, it was an up day on Friday, which was nice, but the price percent oscillator is flat. Derivative oscillators losing energy. What do we see going on that 4-hour chart? Well, it had moved up, then moved down, and now it moved down until the afternoon of Thursday the 18th, up some in the morning on Friday, and then a little bit sideways and down in the afternoon, making for an up day in the end. But again, this sideways sliding pattern is not making our oscillator work very well for us. We did not have the 4-hour chart disappoint us in mid-December through about mid-January, but now it started to disappoint us later in the season than it typically does. Those of you who followed us for a while, you've watched us go through Christmas seasons where the 4-hour chart stops working. Well, it has stopped working past Christmas season this year, and we'll just wait and see. Once it starts working again, we'll use it. But again, when it doesn't work, we can't rely on it. So we'll just continue to keep our eye on things. You can trade gold like we do everything else. Once indeed you see the 4-hour chart crossover going up, you can look to jump back in and move in the same direction as the 2 larger charts, if indeed that does occur. And at some point, that 4-hour chart most likely will start working for us again. If not, we'll find another way. Sometimes you do find charts, though, my friends, that aren't chartable. Now, let me give you that little bit of trading wisdom that I said I would, because we've covered all of our charts, and those of you who have a little extra time, I want to share with you, and again, I'm just going to go a little out of bounds of what we typically look at. I'm going to look at another ETF for you. And I want to show you the value of what I just said a minute ago. When we have weekly vertical crossovers, we talk about those all the time. And weekly vertical crossovers, when they occur, usually mean, even in other charts, and the reason I bring up the China Index Fund is that it had a weekly vertical crossover for the week ending the 12th of January, and then had an amazing week over the course of the last week. And again, as you start going through the other charts, you see, again, the commonalities that we look for. The 2-day chart, of course, was already in a weekly vertical crossover. If they both happen at the same time, it's even better news. Sometimes you do see, we saw it happen in the course of this last year, one of our charts, the 2-day and the weekly crossover at the same time. That's not typical. Usually the 2-day crosses over first, and then that's followed by the weekly. And of course, what happens when that occurs? Well, you look to jump into an up move that following Monday when you can. And invariably, my friends, invariably, when you start doing that, you find that you are able to jump into a movement that continues up. Now, does it always? No. But as we said, all things being equal, the market tends to move in the direction of the largest chart. And I'm telling you, it just happens. And the mathematics goes with it, because as you have that big wave crest or starting to crest, as it moves, it tends to take everything else with it. And then that momentum, as I see it, is what carries forward. Doesn't have to. In fact, it takes it a while. When you start looking for an actual weekly vertical crossover on a weekly chart, you typically see that weekly chart moving up for a while. Not typically as strong up as it did in the China Fund, where it's just really one prior week and then the crossover occurs. Sometimes as you go back, you can see things starting to move up in waves developing over time. As we look back on this chart, we can see the wave sort of ebbing and flowing, and we can see weekly vertical crossovers when they occur. And it's beautiful to use those and the momentum they develop to help you find jumping in points. Now, are they always accurate? No. When we look back at the China Fund, we can see a weekly vertical crossover going down back on the 5th of March. And in fact, it only went down for about a week. And again, that's where you have to use your 2-day chart and your 4-hour chart to make sure that what you are tracking is tracking in the right direction. And if it turns around, then of course you pull your play as quickly as possible, minimize your losses. But if you look at the false movements that happen, they are typically very short term, and they give the opportunity, when you see the change occur, to pull out, minimize your losses, and then almost all the time there's significant time to get in and to ride that pony to nice profits, as long as you pay attention and you remember that all things being equal, the markets tend to move in the direction of the largest chart, which is the weekly. Your 2-day chart can sort of be a forewarning that weekly might be coming. Not necessarily going to happen, but when it does, it typically tells you that's about to occur. And of course, as we talk about the crossing of your 2-day trend line, the crossing of your weekly trend line, those kind of things are warning bells to tell you that maybe this move is ending and you need to get out. And when you darn sure see things go in one direction and then pop back over and cross over going up on the weekly, you damn sure pull your play there and you jump into the opposite direction if it presents itself. You typically don't have multiple fake outs. In other words, you don't have it go down and up and down and up and down and up over the course of the same time period. You usually, even if you do have a short-term period where it's a fake out, as I would call it, you usually have a few weeks of up movement following that, or down movement if it's the opposite direction. So again, the market ebbs and flows, but typically when it ebbs shortly, it will flow longer in the other direction. It usually is not going to slip sideways where there's nothing that you can really look to get into. Now, there are certain charts, there are certain stocks, there are certain ETFs that are just untradeable because they have so little price movement that that's really all they do is slip up and down 50 cents in one direction or the other. We don't look to trade or invest in those. Now, again, these are for our virtual trades. Now, if you are someone who, likes that particular stock or that ETF, if the stock is giving you a great yield and it's something that you don't want volatility in, well, by all means, there are other reasons to do it. But as far as our charting techniques go and what we do and why, that's our thought. So you have questions, problems, concerns, understanding what it is I've just said, I would love to hear from you. And for those of you who understand exactly what I'm saying and have found it helpful, please let me hear from you too. We would so appreciate it. You can always write a CW@chartingwealth.com. As we said, we have some real training coming up. We're very excited about the courses that we're offering, some personalized training, advanced training, and intermediate training. We'll be getting that out to you and in the marketplace here in the next couple of weeks. And again, thank you so much for being with us. From the whole team here at Charting Wealth World Headquarters, God bless you.